Hi, I'm Rick Rivera with Safeguard Investment Advisory Group. I want to take the time to thank you for watching. Our firm is a registered investment advisory firm specializing working with people that are either planning for retirement or already retired. Now, we get a question that comes up quite often. What is the difference between mutual funds and exchange traded funds, or ETFs? Basically, ETF just means exchange traded fund. So for today's video, just a real simple explanation, or to make it easy for the general public to understand. A mutual fund, think of a basket of stocks. So in this basket, there's a bunch of stocks in there of different companies. And what it allows you to do is you can actually buy a share of this particular basket of stocks. Now, there's usually a manager that actively manages those mutual funds, and sometimes it might be a growth fund where the manager, his job is to pick stocks that he feels have great potential for growth. There's others that might have a different objective, maybe dividends, stocks that pay good dividends, and so on. Some might be international bonds or whatever. But bottom line, it's a culmination of a variety of stocks that a manager picks that goes into this basket, and now you can just buy a share of that basket, and now you have a diversified approach by buying one share of this particular fund. Now with the mutual fund, when you do purchase it, the price is established at the end of the day. So unlike a stock where I can buy it in the morning and maybe sell it in the afternoon, with a mutual fund, when you decide you want to invest in it, the share price is established at the end of the day, and then you get the fund at that point. These funds, as they're being actively managed, each and every year there will be gains and dividends that are distributed to you, and you get 1099, and you pay the taxes on these investments as you go along. The difference with an exchange traded fund is, in essence, it's similar to the mutual fund where you do have a basket, and there's a bunch of stocks in this particular basket. However, it's designed to trade more like a stock. So I have a share of these basket of this basket of different stocks in it, but I can buy a share of this exchange traded fund in the morning. I can sell it in the afternoon. I can hold it over a long period of time like I can a stock. But when it comes to taxes, where a stock, the only time you're taxed on the gains is when you sell it. Unlike a mutual fund, each year gains and dividends are distributed to you each and every year. Whether you use that money or not, you're paying taxes on that investment as it's ongoing. So with an exchange traded fund, since it trades like a stock, what's going to happen is that as long as you hold on to it, let's say you bought it today for $10 a share, and next year it's worth $11 a share, well, as long as you hold on to it, you're not going to pay tax on that capital gain. You only pay tax on that capital gain when you actually sell that share. So some of the advantages to an exchange traded fund is that for those that are looking for maybe a little bit more tax efficiency, they may purchase an exchange traded fund because now they can control their taxes a little bit better. There's some other advantages as well. So if you'd like a little bit more specifics on it, and maybe you're wondering, well, in my particular situation, should I buy a mutual fund? Should I buy an exchange traded fund? Maybe I should have a combination of both. If you'd like a little bit more specifics, feel free to click on the links below, and it'll take you to our website, and we're more than happy to schedule a strategy meeting with you. No cost, no obligation. Be able to go into depth with it a little bit further and let you know what might work best for you in your particular situation. Thank you for watching. Please like and subscribe, and I look forward to seeing you in the next video.